The first thing I want you to understand is this, that the accounting standards are intertwined. You see, one of the things that really puts off a lot of people is when they see the list of accounting standards that they have to study when it comes to the corporate reporting examination or the financial reporting exam. So right there, some people are just put off and say, oh, how can I learn all of these accounting standards? No. What you must understand is that the accounting standards are intertwined. The accounting standards are interrelated. For the most part, when you are solving a given question in financial reporting and corporate reporting, you are likely to be applying about 2, 3, 4 accounting standards in just a single question to be able to get the marks allocated to that particular question. So the first thing you must understand is this, that the accounting standards are interrelated. That is the first thing. They are interrelated. Let me give you an example. If you take IAS 16, property, plant and equipment, it has relationship with numerous other accounting standards. Number one, when you take IAS 16, property, plant and equipment, we are going to be looking at initial measurements. When it talks about initial measurement of property, plant and equipment, these are tangible non-current assets that are used in the day-to-day running of the organization, and we call them owner-occupied non-current assets. So for these non-current assets, the initial measurement, in addition to IAS 16, we can have IAS 37 come into town, and that is provisions, contingent liabilities, contingent assets, because if there's an environmental cost or restoration cost that has to be incurred as a result of restoring the place where the asset is being used, then certainly we have to include that in the initial cost of the asset in accordance with IAS 37. Number two, we can have IAS 23 come into town, borrowing cost, because when an entity borrows money to acquire or build a qualifying asset, the standard requires that the borrowing cost must be included in the initial cost of the asset. Then we will come to the issue in respect of IAS 20, government grants. There are sometimes that an entity will buy assets and will receive a grant from the government, or the government may announce a policy and say that, hey, if you go and make this amount of investment or establish a factory in this location and employ, say, this number of people, I'm going to give you X amount of money. So when it comes to IAS 20 government grants, it has some relationship with the way we do the initial recognition of that asset, because we could subtract the total grants received from the initial cost of the asset, or not include it at all and recognize it as a deferred income. So IAS 20, it's there. Then we can also talk about IAS 21, effects of changes in exchange rate, because when we are dealing with acquisition of assets or transactions denominated in currencies other than the functional currency of the entity, IAS 21 requires that we translate the foreign transaction into the functional currency of the reporting entity. And so if we are buying an asset, then IAS 21 is going to be coming to town so that we will get how we will account for it. So that is just an example, and we can even bring about IAS 19, employee benefit, because when we are constructing our own asset or building our own head office, we are paying laborers. The wages and salary we pay to those laborers who are building, who are working on our head office, who are working on that asset that we are constructing or we are building, we will not recognize that in the P&L account. Instead, IAS 19 employee benefit requires that it will be included in the initial cost of the asset. So you realize that just IAS 16, looking at the initial measurement, you are seeing about 5 accounting standards of the records: IAS 37, IAS 23, IAS 20, IAS 21, IAS 19. That is the connection. Then when you come to the subsequent measurements of property, plant and equipment, also there are a number of accounting standards that we can call on. The first one will be IAS 36, impairment of assets. The second one is going to be IAS 12, income tax, because when we do revaluation of assets, we would have to deal with the tax implication of that on the subsequent measurement of the asset. So IAS 12 is going to be coming to town. Then we will have to also deal with IFRS 5, non-current asset held for sale and discontinued operation, because when an entity decides that they are no longer going to use an asset that they are using in the day-to-day running of the organization, and that they want to sell that asset and it meets the recognition criteria, then quickly we have to move from IAS 16 to IFRS 5, non-current asset held for sale and discontinued operation. So on the subsequent measurement, we are seeing impairment IAS 36, we are seeing income tax IAS 12, and then we are seeing IFRS 5, non-current asset held for sale and discontinued operation. Even at the subsequent measurement, we can see IAS 40 also coming into town, and that is investment property, because an entity can again decide that an asset that they are using in the day-to-day running of the organization, now they want to rent it out or lease it out under an operating lease. So then we are now going to account for the asset in accordance with IAS 40 investment property using the fair value model, rather than recognizing it in accordance with IAS 16 property, plant and equipment. So you realize that just talking about IAS 16, we are getting 9 or 10 other accounting standards coming in, making it 11. So that is the first principle I want you to understand, that the accounting standards are not independent. So don't look at it like, oh, a tall list of standards that I need to check. Look at them as they are intertwined, they are related to each other, and they have connection with each other. Because when you look at it with that mindset, it changes your perspective and you see it as a group. So if IAS 16 is having the first group, which is 11 accounting standards, it becomes much easier than seeing it as independent accounting standards that are not having any relationship with each other. Another example I could give you also is 3 other accounting standards that work together always, and that is IFRS 15, revenue from contract with customers, IFRS 16, leases, and IFRS 9, financial instruments. These 3 accounting standards also sometimes work together, especially when we are dealing with IFRS 16 leases and we are dealing with sale and leaseback. So these 3 standards, the principles are going to be coming into being when we are dealing with leases, sale and leaseback transaction. So that is the first thing I want you to understand. Don't see the accounting standards as a tall list of check items that you need to tick off, but see them as items or things that are interrelated so that you can learn them in that order. That is the first thing I want you to understand, that the accounting standards are intertwined with each other, and that is how you need to study them.